Hello everyone, welcome to Just-InvestToday, and today we're going to be talking about 13F filings. Yes, it's so popular right now. Quarter three, everyone's looking at your 13F filings of your top investors like Warren Buffett, Spier, Mohnish Pabrai, and I want to talk about some good things about it, some bad things about it that people are not recognizing. So here we go, let's get into it. So right here I have Spier, but let me go into Warren Buffett quickly. Where is Warren? Warren Buffett. Oh, here's Warren. Warren Buffett. Okay, so as we go and we can see he sold Apple. He bought more Bank of America. It went up 9%. He reduced some here, healthcare partners. Let's go on what's important. He invested into pharmaceuticals. Yes, Warren Buffett invested in pharmaceuticals, or it could be his partner, Todd, or yeah, he has two partners, Todd and another guy. I can't remember his name right now. But guys, when we look at these 13F filings, we want to know, did he make any big investments? We want to focus on the big bets because the big bets are the ones that he's confident in. If we just focus on like these small bets down here, like Liberty and Johnson & Johnson, like those are not the big bets. So we don't know if he's confident in that company or he's just tippy-toeing into these companies just to see the waters. I don't know, like we don't know what he's doing. So when we focus on these 13F filings, we want to look at these big bets like Apple. Warren Buffett is very confident in this company. Bank of America, he's been adding shares there. He's confident in this company. We can go to another investor. Let's go to, who can we go to? Li Lu. Charlie Munger's guy. Charlie Munger really trusts Li Lu to invest his money. So he's a legit investor. And that's another thing. We gotta have a list of investors that we trust with our same values, so we can actually kind of follow and clone these guys. Because these are the good things about these 13F filings. And basically 13F filings are filings that the SEC forces big investors to do. If you have over $100 million and you manage that, you have to file a 13F. It's for the small investors to give some kind of transparency when because you have other people's money, so small investors need some kind of transparency when they're investing other people's money. So the SEC wants you to file these filings, and since it's in quarter three, you can see. So like Micron right here, that's a big bet. He believes in this company. Facebook, big bet. He believes in this company. So this is perfect. So when we see these big investors investing a lot of money in these companies, we can use this information to screen it, come to our own thesis. And this is what I really want to talk about. We know if these big investors that we trust are buying these companies, that means it passed their filter. So they probably looked at how much money it was generating, their debt. But that still doesn't mean we can invest in it. We got to figure out why are we going to invest in this company? Because guys, if we just invest in these companies not knowing what we're doing, and the company drops like a rock, you're going to be afraid. 100%. I've been in that situation. You're going to be afraid, and you don't know if you want to sell it or you want to keep buying more. These guys might be buying more, and you don't even know because they haven't filed their 13F yet, or they might be selling it. So you don't know. So if it's dropping like a brick, what if they sell early and you don't know that? And you just have to wait until the next quarter to see if they sold, and then it's too late by now. You lost another 50%. So it's really risky if you just follow people into a stock without knowing why you bought it. Because if you know why you bought it, you'll know why to sell it. So you got to think about that question. Ask yourself that before you actually make these high bets and you just follow people into stocks just aimlessly. So when we look at all these super investors, the site's called dataroma.com. It posts all these good investors that had to show their stocks. So that's a good thing about it. It kind of provides a screen so you can look at a certain amount of stocks. You don't have to look at the whole market. And yeah, so that's the good thing about these companies. And you can kind of know the price of where they bought it because if I go to Lee Lu, oops, Greg, nah. If I go to Lee Lu, we saw he bought Facebook in quarter three, because it's quarter three filing. He bought Facebook. We can then go to Facebook stock, and look, we can kind of see, what was it like? We can kind of see where he bought it at. So the hobby, like the lowest, it was probably in whatever 248, around that, like 248, 249. So we can kind of see where he bought it at. So that's kind of good. So we can see if we like that price or not. But still, do your own research on these stocks before you buy them. And I want to talk about some bad things about this, because I see a lot of people doing it. They just, when they follow people. See, when Warren Buffett buys a stock, the whole market reacts. When Buffett buys Apple, or Buffett buys whatever company, the pharmaceutical company, it just bids the prices up. The prices go skyrocketing. They jump 15-20%. And then when hedge funds are doing the same thing, they're looking at the same information that we are. So when they see this information, they're putting money in too. So they're just making these stocks overvalued. When these super investors are buying stuff, they're basically going to bid up the price of these stocks. So these stocks become overvalued. So be careful. They might become overvalued and they might not. But just make sure you're not just following aimlessly, because what if that stock just booms and it's overvalued now, and you don't want to get into those overvalued stocks, right? Because you're just going to lose your money in the long term. So make sure, like when you're getting into these stocks again, that you're following good guidelines. And look how much money they have to invest in. Like, look how much Warren Buffett has to invest in. He is not looking for these small companies to invest in. That's why we have such a big advantage, because again, in the book 100 Baggers, Chris Myers says the companies that returned 100x were companies where it started with a market cap of like they had like a 500 million to 1 billion market cap. Those are the stocks that have the long runway. They're gonna go farther. Like Apple. Apple is not good. This stock is not gonna double. Look how much investors are in this. This stock is not gonna. It might double, but it's not gonna quadruple. It's not gonna go to 6x, 7x, 8x. We're trying to look for stocks that are small, in the 500 million market cap to 1 million market cap, and that's when we're not going to see these investors buying those type of stocks, because they have so much money. Remember, they have 100 million and up, billions. They have billions of dollars. Like Warren Buffett has $228 billion. They're not going to invest in these small stocks that we can. We're small investors, so remember that. When we're small investors, getting into these small stocks that a lot of people don't know, or it's not like people are not talking about it as much, can have a really good future. But that's when you got to do more research, because when these big guys buy stocks, we're more secure. We feel good about it. We feel good about our investment. So that's a good thing about looking at these investors. But they're buying stocks that are already big, like Apple, Facebook. Like, look at that. Top 10 most owned stocks: Facebook, Alphabet, Bank of America, Wells Fargo, Microsoft, Berkshire, Comcast. Like, these stocks they're probably not gonna triple in a year or 2 years. They're not gonna triple. They're just too big. You want to buy smaller stocks. Smaller stocks are gonna 5x, 6x, and 7x way faster than these big stocks. So we have a bigger field to invest in. So think about that, guys. We have a much bigger landscape to invest in. So when we're looking at these people, be aware of that. We don't have to follow everything they do. We can use this as a guideline, and just use these as a guideline to what we're going to invest in. Let's go to another person, Mohnish, see what he's done. Okay, so he stayed the same. He hasn't done any things, but he made these big bets. So these big bets, when you make these big bets, you know they're serious about this investment, and we can look into it, because it's a big percent of the portfolio. So we can look into these investments. So yeah, that's all I gotta say for this video. So just be careful when you're looking at these 13Fs and all these stocks. because you don't want to get caught up in the herd mentality, this following what everyone else is doing. And because remember, at the end of the day, we're contrarian investors. We are investing in stocks that sometimes are smaller, and because that's where we're gonna make the big money. When these companies are small and then they turn into $4 or $5 billion companies and they start from 500 million, that's when we're gonna get these big returns. So keep that in your head when you're looking at these 13 Fs. We're small investors. We have little money, so we can still invest in small companies that are still making 150 million in revenue, which is really good. It's not really a small company. A small company that has a 500 million market cap and 150 dollars of revenue, $150 million of revenue. That's a pretty big company. So that's what I gotta say for this video. If you like this video, please like it, subscribe to my channel, and I get back at you. Peace.